Hi friends, welcome to Trending Sutra, a small start for sharing knowledge and know-how on trading and investing in commodity, forex and future markets. Here, this is our first vlog, again a small step, and frankly, we are still nice here in doing this stuff as these days reading has been replaced by vlogs. So work is still in progress as far as presentation is concerned, but today we are here to discuss about uh, why gold prices fell this month in February, and would rather say it is more or less a crash in the market in last 3 days. What actually happened in the last few days that gold fell by more than 6% in February month, and more importantly in last 3 days, on Wednesday, Thursday and Friday combined, it fell by 5%. So majority of the fall of this month contributed from last three session of this month, where it fell by more than 5%. uh, Basically, if we talk about the factors and the reasons behind its fall, we consider there are three major factors which drive the prices of gold downward towards south. The number one is about US bond yield. You might have heard on various news portal, business news channel, where everyone is discussing about US bond yield because of the rise of bond yield, stock market crash, and other asset prices actually fell down in last few days. But why gold actually, in among the commodities, why gold actually hit so much that it fell by more than 2.5% in late Friday? Because since the start of this year, US bond yield are actually rising. It started from 1%, like less than 1% in January 2021, at the start of January 2021, and uh, from uh, from January it rose by more than 50%, like till the February month, till the last trading session of February month. It has been increased by more than 50%. So what actually triggered the market? So on 25th, what happened? It hit 1.6 on a flash trade, the US 10-year bond yield. uh, and after it hit 1.6, it cooled down to 1.44, around 1.44 in the day. So what happened actually, whenever there is a rise in bond yield, it actually undercut the demand in gold as investment. Because whenever there is a rise in the bond yield, it increases the cost of holding gold, which actually pay no interest or dividend, unlike bonds and stocks which pay dividends and interest. And that is why whenever there is an increase in bond yield, we see shifting of money from gold to much lesser riskier assets like yields and dollar index. What happened is that uh, due to two factors, basically bond yield rising. First of all, it is inflation. Market is expecting inflation as a very major factor. That is why we see such shot up in the yield prices, and expectation of future increase in the rates by Fed, because Fed is now left with very minimum tools to address the current monetary situation. Whatever tools Fed had, it has already used in its arsenal. And despite assurance from the Fed, the market is more worried about overheating asset prices and inflation. Uh, and It is just reacting to the market condition and market situation, what we are seeing right now. The 10-year, the difference between 10-year and 2-year yield also increased by more than 80% since March 2020, and it hit almost 140 basis point. The difference between 10-year and 2-year uh, is actually hit 140 basis point. Previously, when we see in 2019 and 2019 and 2020, this gap actually shortened, uh, decreased to almost 27-30 basis point, which is now actually increased to 140 basis point, which actually one of the reason why there's a sudden sale off happened in the bond market. And whenever the bond yield increases, the bond prices decreases. So when this difference increasing and bond yield start increasing, so there was a sudden sale off, everyone just coming onto the street and selling their bond holding. So the bond prices start decreasing, and we see sale off in bond market, and the bond yield actually increasing, because market is expecting inflation risk and few other factors. The number two factor, which is a very important factor in terms of when we are discussing about gold as an investment, is that gold is now no longer a prominent destination of investment or an instrument, a primary instrument to hedge against inflation, as has shown in the past. Right from the start of this year, an increase in the yield prices, the dollar index has not shown much strength compared to what it had shown in November last month, and gold fell to 1764. We remember on 30th November 2020, gold actually fell to 1764 from 1965, because dollar index rose to around 94.90. It reached 94.65, 94.70, and gold start falling because of the increase in dollar index prices. Whereas Bitcoin, on the other hand, has given approximately 50% return absolute from January till date. It is approximately here and there 3 to 4%. So what actually happened? The loose money, the money which is coming from the quantitative easing, has shifted in large from gold to Bitcoin. SPDR gold holding, which is the largest exchange traded fund backed by physical gold, showed a net decrease of 10% holding from its peak when the gold price is ever $2,000. So technically from August onward, 2020 onward, the holding of SPDR actually decreased by more than 10%, which is quite substantial. And we have seen the prices actually peaked around that level around that time, and the prices actually falling from that level and from that time. While on the other hand, what we have seen that gold, the silver, which is another precious metal and also as an industrial metal, has seen its holding increase by 80% from March 20, when actually silver bottom out. If you remember, in March 2020, the silver prices fell like a pack of cards, and at that point of time, silver actually bottom out. But whereas we have seen the decrease of holding in gold, we have witnessed, the data says that there is a 80% of increase of holding in the silver, and which is visible, and which is why the gold silver ratio, a measure to calculate how much silver one can be bought in 1 ounce of gold, peaked exactly in March. So in March, the gold silver ratio peaked around 127, and from there it start correcting, and has fallen by more than 45% since then. The ratio fell to 62.32 in February, a level last seen in August 2014. So this is a very significant change in the gold and silver market, whereas the sell off in gold versus silver is backed with data, and the ratio actually fell to 62.32 and below 65. this month. uh, One of the news which came mid of the February, when BlackRock, which is one of the world's biggest asset manager in terms of asset, disclose under their filing with the SEC that they have actually sold 2.7 million of it's their shareholding in SPDR Gold, and they actually bought 1.18 million shares of iShare Silver Trust, that is equivalent to SPDR Gold exchange fund. So basically what BlackRock actually has shifted, what have done, they have shifted their holding in gold to silver. So they sold their holding in gold and they bought silver in the last 3 months of 2020. And we have seen that from October, the gold silver ratio from 82 fell to 65. So continuously it is falling from October, November, December, January until February. So this is a very larger shift from gold to silver as far as the investment is concerned, and this is predominantly because of two major asset, Bitcoin and silver. So gold, which used to be a primary target of investment, has been shifted to Bitcoin and silver. So this is one of the major factor why we have seen so much of pressure in gold prices, despite so many factors which could be helpful for the gold prices. But we have seen a very significant sell off in gold prices. Now the number three factor, very importantly, uh, psychologically what happened, retailers which were shorting gold uh, change their strategy from shorting to buying on dips mode, whereas the institutional actually just doing the reverse. So earlier institution buying the gold, and retailers were shorting the gold in the future market. So the reverse actually has happened, and we have seen how the gold prices are falling, and no dips actually are sustainable in the market as of now. Even the last man on the street preferred to go long in gold despite rather than shorting it. So that's a very major psychological shift happened in the gold in last 2 years. On the technical front, gold turned technically bearish when actually it failed to break 1817 late January this year, and it started falling down below its 100, 50 and 21 DMA in February itself. The psychological support of 1800 also broken, not able to regain as a major factor of quick sell off in gold. It doesn't hold $1800 at all in the market. It bounced back again. It bounced back above $1800. It again fell back below $1800. So it is not able to sustain $1800. That was one of the reason. Technically, it see a very good and quick sell off in the market. So when it fell off below 200 DMA, broke even its previous support around 1760 in quick moves late Friday, we have seen a very significant sell off below 1760, below 1757. Was seen. The sell off was quick, steep and deep. On the parameter, actually gold has turned bearish technically, and every rise may become an opportunity to sell it further. That is just an assumption we are expecting. Actually, what happened on the Friday, there was lots of stop loss placed below 1757, and once it break that 1757, we have seen how it fell like a pack of cards. That also triggered a very this also triggered sell off in the market. But anyhow, it managed to hold 1770, which is it's approximately a 2013 2014 resistance channel, and which may now act as an interim support for the gold technically. That's it for now. In the next video, we will discuss gold in Indian contest in MCX pricing and all that stuff, where gold prices headed in MCX and globally, how the rally started and ended it in this cycle, and much more. So we try to wrap up this in a short, but still it got um, more than 14-15 minutes. So please do share, subscribe, and there will be more description will be provided in the link. We will try to make it more presentable with charts and other stuffs in our next few videos. As of now, for the time being, you just content with the content of this discussion, and thank you for watching.